Hi friends, today I'd like to present before you the rules of debits and credits in accounting. There is a golden rule which most of the accountants are following, and I'll show you an alternative way also which is more logical as per my observation. So we first start with the golden rule. As per the golden rule, there are three types of accounts, as you can see: personal account, real account, and nominal account. So there are three rules for each of these three accounts. Personal account have a rule, real account have a rule, and nominal account also have a rule. We'll go through these rules. First comes personal account. So this is the rule. As per personal accounts, debit the receiver and credit the giver. Okay, I'll explain you with an example. In case of a credit sale, what will be the entry? The entry will be sundry debtor or party account debtor to sales. So the party is receiving goods from us, and the party head will come under the personal account, and we should debit the receiver. That's the rule saying. So we will debit the sundry debtor account and credit sale account. Then comes real accounts. As per real account, this is the rule: debit what comes in and credit what goes out. For example, we are purchasing a fixed asset for cash. Then the entry will be fixed asset account debtor to cash. Why this is coming? Because machinery is coming into our business and cash is going out of our business. That's why the entry is fixed asset account debtor to cash account. That's all about real accounts. And then comes nominal account. Nominal accounts, the rules is debit all losses or expenses and credit all income or gain. For example, we are paying any expenses, let's say salary to our employees. So salary is coming under the expense head and it should be debited. And what we are giving is cash. Cash is coming under this real account head and cash is going out of the business. Then we should credit the cash. So the entry will be salary account debtor to cash account. So that's a golden rule, and now we'll go through the alternative way. As for the alternative way, there are 5 parent groups for ledgers. These are the 5 parent groups: assets, liabilities, owner's equity, revenue or gain, and expense or losses. These are the 5 parent groups of ledgers. All the ledgers coming under these two financial, these are balance sheet is a financial statement and income statement or profit and loss account is another financial statement. So it will be easy to understand when you are going through the financial statement. There will be a lot of ledgers coming under the balance sheet and profit and loss account. So each and every ledger we can categorize under these 5 heads: assets, liability and owner's equity, revenue and expense account. So let's go through few examples of these ledgers. Under assets head, cash, accounts receivable, machineries, inventory, prepaid expenses. These all are examples only. Accounts payable, accrued expense, bills payable, unearned revenue will come under liability groups. And capital, retained earnings and all will come under owner's equity. These three heads are from balance sheet and from income statement, revenue or gains, and expense or losses. These are few ledgers coming under these groups. So now we'll go through the rules of debit and credit in the alternative way. These are the rules. Any ledger coming under this assets group, if it is increasing, we should debit it, and if it is decreasing, we should credit it. That's the rule for this asset group. And for liability group, it is just opposite to that of the asset group. If it is increasing, we should credit it. In the asset we have debited. If it is increasing, liability we should credit it, and if the liability is decreasing, we should debit it. Same is the case of this owner's equity. If it is increasing, we should credit, and if it is decreasing, we should debit. Same for revenue head. If it is increasing, we should credit, and if it is decreasing, we should debit. And expense head is same as that of the asset head. If it is increasing, we should debit it, and if it is decreasing, we should credit that expense. So as you can see, asset and expense heads are having a common role, and liability, owner's equity, and revenue are having a common role. So just keep this in mind. Now I'll tell you how to apply these rules. First, you will be given a transaction and you will have to pass a journal entry based on that transaction. So first step is analyze the transaction. Analyze each and every word of this transaction. And the second step, identify the ledgers affected. There should be two or more ledgers affecting a transaction. So you have to identify all the ledgers affecting that transaction. That's the second step. And in the third step, you have to identify the parent group of ledgers. These groups you have to identify. First you have to identify the ledgers and identify the parent group of each ledgers. Then apply the rule. This is the rule. These rules you have to apply. Then only you will get a journal entry based on that transaction. So now we will go through few examples. I'll give you 4 transactions and we will complete the journal entry of these 4 transactions based on these rules. First transaction is owner introduced cash to business. So our owner is introducing cash to the business. We have analyzed the transaction, and the second step, we have to identify the ledgers affected. So 2 ledgers are affecting this transaction. One is capital account of the owner, and second is cash. Cash is coming into the business. So we have identified the ledgers affected, and then we have to identify the parent group of these ledgers. The parent groups comes here. So our 2 ledgers are cash account and capital account. Here cash comes under assets head and capital is coming under owner's equity head. Okay, so we have identified the parent groups affecting the ledgers, and then the fourth step is apply the rule. So this is the rule. We have 2 parent groups, assets and owner's equity, and when this transaction is happening, cash is coming into our business, so cash is increasing, and also the capital of our business is also increasing. So whenever an asset is increasing, we should debit it. So the ledger to be debited will be cash in this case. And in owner's equity, the capital is increasing, we should credit it. So the ledger to be credited will be capital account, and the entry will be cash account debtor to capital account. Now we'll go to another example. Purchase of fixed assets for cash. So now we have analyzed this transaction and we have to identify the ledgers affecting. We are purchasing a fixed asset for cash. So there are two ledgers affecting. One is fixed asset account and the other is cash account. So now we have to identify the parent group of ledgers. We'll go to the sheet. Fixed assets like machineries, furniture and all will come under the assets head only, and the second ledger is cash, that also is coming under the assets head. So we all have to look this assets head only. What assets head is saying? Whatever is increasing, you should debit it. When we are purchasing a fixed asset for cash, fixed asset is coming into our business. So fixed asset is increasing, that should be debited, and what is decreasing, our cash balance is decreasing, so that should be credited, and the entry will be fixed asset account debtor to cash account. And this is the third example, credit sale. When you are selling any goods for credit, then two ledgers are affected. One is sales head, of course, and the other one will be sundry debtors head or accounts receivable head. So two ledgers, we have identified the two ledgers and we have to identify the parent group of the ledgers. That's the next step when we will go to this one. And sundry debtors or accounts receivable is coming under the asset group, and the sales or revenue is coming under the revenue head under income statement accounts. So we have identified the parent groups. Then we'll go to the rules, and in case of asset, if it is increasing, it should be debited. In case of credit sale, the accounts receivable value will increase after this credit sale. Also our sales will increase after this credit sale. So both are increasing. If asset is increasing, it should be debited, and if the revenue is increasing, it should be credited. So the entry will be accounts receivable or party name account debtor to sales account. Now we'll go to the last example, traveling expense paid in cash. Traveling expense is being paid in cash. So we have analyzed the transaction and we have to identify the ledgers affecting. So traveling expense is one ledger affected, and cash is the another ledger affected. Now we have to identify the parent group of these ledgers. We will go to this. One is cash, it's coming under the assets head, and the other one is salary, it is coming under this expense head. So we have identified the parent heads, one is asset and other one is expense. Both are having the same role. So we have to identify what is increasing and what is decreasing. Our expense is increasing and our cash balance is decreasing. So whenever expense is increasing, it should be debited. So traveling expense we have to debit it, and our asset means cash is decreasing, so we have to credit it. So the entry will be traveling expense account debtor to cash account. So that's all for now. I hope you understand the rules properly. If you have any queries, please feel free to comment it, and please do subscribe my channel for more accounting related videos.